Hello, everybody. Thank you for joining us today. We're going to give about a minute to let everyone get settled in, and we will get started. All right. Hello, everybody. We know your time is valuable, so thank you so much for joining with us today. We're pleased to introduce Mehul Pujara, Senior Internal Sales Consultant at Allianz. With over 8 years of experience in the financial services industry, Mehul brings a wealth of knowledge and expertise in marketing Allianz's life insurance products. He excels at guiding field marketing organizations, independent producers, and financial professionals, providing them with the tools and insights needed to achieve their goals and enhance client outcomes. Today, we will explore proven strategies to retain assets within your existing book of business and attract new clients amid this wealth transfer. Through a detailed case study, you'll gain actionable insights and leave equipped with practical tools to immediately incorporate into your practice. With that being said, Mehul, the floor is yours.
Thank you so much for that introduction, Emma. Good morning, everybody. First and foremost, I want to thank you all for taking time out of your day to be here today, and thank you to NFI Solutions for hosting this webinar. The goal here really today is to make sure that you guys walk away with some form of value. You are taking time out of your day, and trust me, that is greatly appreciated. So I want to make sure that you guys get something out of it today, whether that's a concept, whether it's an opportunity, or whether it's just strategy in general on how to actually look at your book of business and enhance upon it, right? Because let's face it, we are all in sales in one way, shape, or form, whether you're an advisor or a producer. I want to make sure that you take away something that's going to enhance your practice. So with that being said, what I want to do today is I want to take away a couple of items from a planning perspective when you're talking to your clients out there. And then I want to show you our new product and how that's going to help you utilize that in the field. So taking those strategies and using our product to help you enhance your practice. So that's the goal for today. We're going to go through a little presentation. It should take maybe about 30 minutes or so to go through the presentation. And then we're going to have a little bit of time there at the end to look at some Q&A. So with that being said, I want to get started here. Intergenerational planning. This is actually a concept. It's one of my favorites because the impact can be so great for your clients. Now, a lot of you might be insurance-only producers. You might be financial planners and advisors. Every single person that I encounter in this business, typically, they usually have an annuity base of clients because that's a very easy transactional sale. And going through that process, you learn about your clients, right? You learn about things like their net worth. You learn about what their goals are in life. You learn about what their cost of living is. You learn about things that are going to carry them through the rest of their lives. Now, with that being said, it's typically an older demographic. And people think, okay, well, annuity sales, maybe some money management, that's really where it ends for me. But in the case of intergenerational planning, you can take it a step further because you can not only look at their lives, but you can look at their next generation's lives. Because in many cases, in annuity sales, you have people that have a substantial amount of money, and they are probably not going to use that money in their lifetimes. So how do you help them pass along that wealth to their next generations? For some of you, you might be familiar with the Tax Reform Bill of 2017, where basically the amount of estate that can be passed along to next generations was actually doubled. But it was only doubled for a very limited amount of time. It used to be $5 million per person or $10 million per married couple. What they did in 2017 is they doubled that. And so now they were able to leave, in actuality, with inflation and everything, they're actually able to leave behind up to $26 million to their next generations. Now, that is a very specific type of demographic, high net worth, doesn't always be a fit for the type of clients that you might be working with. But again, that is sunsetting at the end of 2025. And it's going to revert back to the amount that was prior to 2017, which was $10 million per couple. Now, if you have any clients that have in excess of that, they're going to run into an estate tax problem. So a lot of those people are looking for strategies on how to pass down that wealth without having an estate tax problem. But then again, it also fits for those clients who might have maybe just a few $1,000,000 that they might not be using throughout the course of their remaining years. So intergenerational planning is a great way to do it. So I want to talk to you a little bit more about that today. And using Index Universal Life can help with things like supplemental college funding for next generations, access to potential funds that can help pay off debts or other financial obligations, and the opportunity to supplement retirement income for those next generations. And the beauty of this whole thing is by helping out this generation and their next generations, those people will also learn to trust you as a valuable insurance producer or financial planner and advisor. So again, I want to talk to you a little bit about this hypothetical couple, Mike and Sandy. Okay, Mike and Sandy, they're retirees. Maybe you've sold them a couple of annuities, and now they find out they have a new granddaughter. Okay, they start thinking to themselves, okay, well, we have more money than we're going to spend in our lifetime. How can we help do things like fund Emma's college education while we help our daughter at the same time? Okay. And when you think about college costs are on the rise. Okay. Just you can look here on the screen, and the amount of money that is going towards education these days is astronomical. And I know this for a fact too, because I have a niece and nephew who are now of college age. And the amount of money, even with grants and scholarships and things like that, is astronomical, right? So Mike and Sandy, they're fortunate enough to have worked hard their entire lives. They have a good source of income for their retirement, but they also have excess, estate that they need to pass along. And so now they look at it and they say, okay, how do we do this? And how do we do this in a tax efficient manner? Well, the annual gift tax exclusion is currently $18,000 per person. This is something that they can gift to their next generation without any taxable impact to either themselves or their next generation. So Mike and Sandy say, you know what? Let's gift $30,000 each year to their daughter, Jessica, and her husband, Todd. So they gift $30,000 a year, which is under the annual gift tax exclusion currently. So there's no taxable income there. So Jessica takes that money and Jessica purchases an Index Universal Life policy from you. She is the owner and the insured and pays the premiums. So again, they're gifting $30,000 a year, and they plan to do this for the next 17 years. Now, Emma's protected should something happen to Jessica and will benefit from future policy loan coverage to cover her college loans. So Emma's protected. Jessica's got an opportunity here to build some accumulated wealth inside of that Index Universal Life policy. And again, I want to tell you a little bit about this example because this is run extremely conservatively. This is run at basically an assumed rate of 5.5%. Okay. We normally run our illustrations at 6.72. So this one is run extremely conservatively at 5.5%. And again, Jessica's 36 years old. So when we look at this, we say, okay, if we were to fund $30,000 a year into an Index Universal Life policy for the next 17 years, and at the end of year 20, they take out a policy loan tax-free of $200,000 to pay for Emma's college funding. Okay. So they're just going to take that money out of that policy that they have, and they're going to pay $200,000 for Emma's college funding. Okay. At the end of year 25, they're going to say, you know what? Let's take $200,000 out of that policy and pay off our mortgage, right? Jessica and Todd say, we got a couple $100,000 left on the mortgage. Let's get rid of it. So they take that money out of the policy, pay off their mortgage. Now, Jessica's and Todd's supplemental tax-free retirement income that they can utilize at the end of year 31 is projected at $122,000 tax-free for 20 years. Okay. And let's say Jessica passes away basically that's at age 92. That's a typo there. But at age 92, Jessica passes away and Emma receives a tax-free death benefit of $1.35 million. So what does that all come to? Total premiums paid by age 65 is $510,000. Remember, they're getting a $30,000 annual gift from the grandparents or the parents of Jessica, and that's a total of $510,000 over the course of 17 years. Okay. Death benefit at age 66 is projected at $1.5 million. Total distributions, this includes $200,000 for Emma's college. This includes $200,000 for Jessica and Todd's mortgage payoff, and then their tax-free supplemental income of $122,000 a year for 20 years is a total of $2.84 million. Now, the death benefit at age 92, should Jessica pass away at that age, projected at $1.35 million. That is a total benefit paid to the insureds of $4.19 million. Let's call it $4.2 million for the low price of $510,000. Now, let's look at the benefits of what this does. If, let's say, Mike and Sandy didn't do this strategy and they just pass along that $510,000 to Jessica, okay, what good does that really do them? Yeah, there might be some growth in there, but do you think that they're going to get $4.2 million of tax-free money out of it? No. So again, this is helping Mike and Sandy. It's getting money out of their estate so that they potentially don't have an estate tax problem. It's helping out Jessica and Todd. It's helping out their granddaughter as well. Again, $4.2 million of tax-free money passed along for $510,000 that was going to come out of Mike and Sandy's estate anyways, going to Jessica. So do you think that they might see a benefit in something like this? And again, this is run extremely conservatively. So this is run at a 5.5 percent rate of return. If they were to actually be getting more than that, these numbers are going to go up astronomically. So again, now you might have sold them annuities. You might have made some commissions offset annuities. By selling this life insurance policy, and I'll tell you right now, this life insurance policy, I ran the illustration prior, is going to have a target of about $10,500. So think about it from this perspective. If you can find one opportunity in your book per month at a $10,000, just round it down to $10,000 commission, right? $10,000 extra per month, $120,000 a year. Do you think you could use that in your practice? Okay, I want you to really think about that. Think about your book of business, because again, it's all about mining the opportunities in your existing book. And I know many of you sell annuities, and this is just an opportunity to look at that demographic where you might not think about life insurance because they're older. Maybe they already have life insurance, or maybe they just don't need it anymore. Now you have the opportunity to look at the next generations. And again, as those next generations accumulate wealth, you have the opportunity to take that wealth into your own book, because they're going to learn and trust you for the opportunities that you provided them. So there are resources out there on the Allianz Life Producer Portal. There's a college funding brochure. There's a tax efficient gift strategy brochure. There's tons of information out there. And if you guys have questions about where to find it, you can always reach out to the Case Design team. You can reach out to myself. You can reach out to NFI. They can help you get all of these resources at your fingertips. Now, how do we accomplish this plan, right? Let's say you find somebody. How do we accomplish it? Well, the Life Accumulator IUL is our brand new product that we launched back in July. So this is going to help you. This is the product that is going to give your clients the most opportunity for success over the course of time, because this, again, is a long-term strategy. You have to think about this from not an immediate source of getting income like an annuity. This is a long-term strategy, right? It's a growth strategy. It's an accumulation strategy. So for those of you that are familiar with our old product, the Life Pro Plus brand, we had a 13-year run with it. We retired it back in July, and we made some enhancements, okay? The changes that we made are huge, okay? We made some pricing adjustments. We brought down our premium loads. So the cost of this actual policy has come down quite a bit. We removed the supplemental premium load, which used to be on there, which was at 14% on the old product. We removed it. Now, basically, it's just a straightforward premium load, 9% year one and 5% years two and beyond. Okay. We also addressed target premiums at older ages. There was something that changed with the 7702 guidelines where we didn't adjust in our old product back in 2021. So the target premiums at older ages, while they were great and high from a perspective of compensation, they ate into the accumulation a little bit because the costs were higher. So we brought down some of our target premiums in the older age demographic for those clients who might be in their 60s and still want an IUL. Okay, so from a cost efficient perspective, it allows for greater accumulation. For those of you that are familiar with the old product, all the bonus structures have remained the same with the exception of the classic bonus tier. It used to be a guaranteed 90 BIP guaranteed flat rate bonus annually for the life of the policy. We bumped that all the way up to 1%. So now, in effect, that's making your floor 1%. So no matter what happens, if the indexing strategies are negative 1 year, they're always going to receive at least some crediting of 1%. So that's a nice little added bonus there. The premium deposit fund, for those of you that are familiar, this is if somebody knows they're going to do an IUL and they have a lump sum of money just sitting in their bank account, they can put that lump sum of money into the premium deposit fund and spread the premium out anywhere from 3 to 10 years, and they will actually receive a premium discount credit of 6%. Okay, it's the highest in the industry. So any premium that hasn't been allocated to the policy is earning basically 6% interest. So great opportunity for your clients to say, take that lump sum that they were going to put in as premium anyways and get more premium going into the policy. They're getting an additional 6% basically going into that policy. So that's a great opportunity there. So it's another change that we made. We also added new indexing options. Okay. We used to have basically your standard S&P options. There was 3 of them. Those all had pretty much caps on them. And then we had our Bloomberg and our PIMCO, which are volatility and controlled indexes. We added a new blended futures index and a new S&P 500 futures index, both lockable, both fully uncapped, all bonus options available on those. We switched from the Bloomberg US Dynamic Balance 2 ER index to the Bloomberg US Dynamic 3 ER index. Basically, what we did was we removed the bond component from it, and it is now basically just a straight equities and cash component as well. The Bloomberg and PIMCO are still both volatility-controlled indexes. The blended futures and the S&P futures are not volatility-controlled. They are straight equity components. And with index lock, for those of you that are familiar, and we'll talk a little bit about that in a minute, we added the index lock lower threshold, which is something that the annuity side has had for a little while now. We added it finally to the life products. So it's a great opportunity for your clients to still have that safety net. Again, index lock is there to remove that midterm market volatility. And now having both the upper end target and the lower lock threshold, it's now giving them that safety net on the downside as well. For those of you that are familiar with us and the life side, we have had our risk class upgrade program running basically for almost 2 years. It is extended through 9/30, basically Q3. And what I will tell you about that is if you have clients who are in simply just average health, this is a great opportunity for them to take advantage of our best risk classifications and lowest cost of insurance. It is sunsetting on the 30th of this month, but any applications received prior to 3 o'clock Central on the 30th will still have access to this upgrade program, even if they still are going through underwriting and all of that. So again, this basically, it's pretty simple the way it works. As long as they get a true standard from our underwriting team, we will upgrade them all the way to our best risk classifications. And again, we're an accumulation-based product, so it's extremely important to think about the fact that having the lowest cost of insurance just enhances that accumulation potential. So if you can, please do take advantage of this. I know we only have a few days left of it, but you may have those clients at the back of your head that you're thinking about. Get them in, get those things applied for as quickly as possible. Again, talked about the new index options. The S&P futures, not a volatility controlled index. Again, it tracks a 3-month S&P futures. It is equity only, no bond component. The Bloomberg, which we shorten that, we call it the BUDB. The BUDB 3 is the new volatility controlled index. It's an 80% large cap, 10% small cap, and 10% tech. No bond component. We removed it from there. It uses an unallocated cash component. So the blended futures, not a VCI, again, predetermined blend guaranteed for all years. There's a 40% bond component to it. And then the equity components are going to be a mix of both US and international based equities. So it gives people that blend of both US and international stock options. Okay. So those people that want to have a little bit more global exposure, this is going to be a good one for them. Again, our allocation lineup here, we still have the PIMCO. The PIMCO has not changed. That is a mix of both equities, bonds, and cash. And again, that's a volatility controlled index. So we shift based on a realized volatility between bonds and equities. So the higher the volatility, the more we'll shift towards a bond component. And the lower the volatility, the more we'll shift towards an equity component to capture more of the upside in the market. So a lot of you might be asking, S&P futures versus the S&P 500 index, how does that track in comparison? If we look here, in many cases, the S&P futures actually almost tracks a little bit better than the standard S&P 500. And the great part about it is uncapped with an 80% par rate currently. So again, if we take a historical look back between the two, if you had the 12.5% cap that we have on the S&P 500, and again, that's one of the highest caps on the S&P in the industry. So if you had that 12.5% cap going backwards, and you look at the average between the two, the S&P futures is actually an average of 11.17, whereas the capped version is going to be an average of 8.15. So great opportunity there. We took the advice from the field because everybody was saying, can we get the S&P in a lockable format? Well, we can't actually lock the S&P 500 because you can't hedge for that. And that's really where the S&P futures is a great opportunity from that perspective. Again, the blended futures versus the regular blended index that was on the old product. It had an 8.75% cap. If you look at the two in comparison, you're looking at a 6.35% average on the capped side versus 10.77 on the uncapped side. So again, greater opportunity for growth for your clients. And then again, the BUDB 2 versus the BUDB 3, all we did was remove the bond component and just to create a little bit more consistency. The averages are going to be relatively close, but the thing that happened in the last few years, and for those of you that might have sold our product prior, you know that it was a little bit rough and bumpy post-COVID. And the reason why is there was that unforeseen bond volatility component with the rising interest rates. So this takes that unforeseen bond volatility out of the equation now. And we have the PIMCO, which still has the bond duration overlay on it, which helps combat that bond volatility. But we just looked at it and we just said, let's take the bond component out of the BUDB. We don't need two of these volatility controlled indexes with a bond component. Let's just go straight equities to create a little bit more consistency. Now, index lock. This is the greatest feature you can possibly pass along to your clients, okay? It is the only feature in the industry. We're the only carrier that's currently doing this. And the reason why is we're the only ones who really can, because we do our own dynamic hedging in-house, and that's what allows us to execute things like index lock. And this is just to help reduce the possibility of your clients receiving a 0 year. Is it going to work every time? No, because as we know, within the markets, every 10-year cycle is going to have at least 2 zeros. It's just the nature of the markets. There's always going to be fluctuations up and down. However, this gives the opportunity for your clients to take out a little bit of that midterm volatility, because as their policy year progresses, they may look at their policy, you may look at their policy and say, you know what? It's sitting at 9%. We've got 6 months to go. Let's just take the 9%. We're happy with 9%. Because even if after they lock in at 9%, the index goes negative by the end of the year, we're going to credit them 9%. So this is just a great opportunity, again, for your clients to really set themselves up for success. And that's what we want. We want your clients to succeed, because the more that they succeed means you're going to succeed, NFI will succeed, and so will we. So if we have a good product, we have the opportunity to help them, let's help them, right? So we added the lower lock threshold, which I talked about a little bit before. We have an auto lock opportunity now, both on the upper end threshold and the lower lock threshold. They can manually lock any given day as well if they don't want to set those targets. But how does it really work when you set that auto lock example? So how do you initiate this lock, right? So let's say you go in there and you look at it and their opportunity is currently sitting at 7.77% as a lockable opportunity. Now it's only, let's say, month 5 of their policy year. You can go in and set the upper end target because they want to see where it goes because it's been trending upwards. So let's set the upper end target at 12%. Let's really shoot for a good opportunity on the upper end. But they don't want to go too much less than 7%. Let's set the lower threshold at 7, right? So now they have the opportunity to have that safety net because if things really go south in the market, they know that they're going to get somewhere around 11%, somewhere around 7% or a little bit less. So you can request that. So now they have that range, right? If it gets up to 12, great. They're going to get locked in at 12. And that's the crediting they're going to get at the end of the year, no matter what the index does after that point. If it's fully negative, doesn't matter. We're going to give them 12% crediting. And now let's say it's at 8.9%. And they say, we're good with 8.9. You can go in and manually lock, right? On any given day, you can say, I want to request the manual lock. Let's be done with it and call it a day. And the 8.9 or roughly thereabouts is what they're going to get crediting at the end of the year. Tools. How do we give you the tools to help you succeed? The one thing that we can do is you can go in yourself and run an index lock report. This is going to give your clients the opportunity. You can say, hey, show me any policies that have lockable opportunities over 7%, 8%, 10%, whatever. And it will show you all the policies. So this gives you another touch point for your clients. You can reach out to them and say, hey, you know what, Mike and Sandy, this is at 9% right now. We have 6 months to go, 5 months to go of your policy year. Do we want to take the 9%? If they say yes, great. Let's go ahead and lock it in. Okay. Gives you another touch point for your clients. The other option that we'll give you is every other week from your territory external wholesaler, you're going to get emails every other Monday on all lockable opportunities over 5%. So again, we're going to tell you, hey, these are opportunities that are sitting out there. These are opportunities for another touch point with your client. Maybe something's changed with your client too in the time that you last spoke with them. Maybe they have a new granddaughter, Emma, right? Maybe that's an opportunity now that you can look towards for helping them with some intergenerational planning. Now, what is the value that this provides? If we look at when we started Index Lock in 2019 up through now, the average locked in value is 9.9%. So just shy of 10%. I want you to let that number really sink in. This is through COVID, remember. This is with all the market volatility that we saw. The average locked in rate on all those policies is almost 10%. We illustrate at 6.72. Okay. Think about that. If you can even get a percentage point or 2 or 3 more than what you're illustrating, your clients are winning all day long. So again, lockable index lineup, when to choose. Again, one of the biggest questions we get asked is, what should we put our clients into? What indexes should we use? Well, guess what? I don't have the crystal ball. Neither do you. If we did, we wouldn't be here today. I'd be living on an island somewhere. So, again, you can't think about this from the perspective of chasing returns because, again, what one index does in any given year might not happen the following year. So we see a lot of this. People chase returns because they're like, hey, you know what? We were in the PIMCO last year. It didn't do anything. Let's switch it all to the BUDB because that did really well last year. Well, now the BUDB doesn't do very well. So the idea here is we can't predict, right? We don't know what's going on here. Let's just look at a couple of examples here. 2015, continuation of strong growth, right? 2013, 2014, saw strong, steady equity growth. Interest rates fell in 2014 and volatility began to spike in late 2014. The economic forecast was strong for 2015. What index would have made the most sense? Okay. The fixed account, actually. The fixed account would have been the best option. Would anybody have chosen that? Probably not, because they didn't know what was going to happen. 2020, beginning of the global disruption we all like to call COVID, right? Throughout much of 2019, markets saw steady increases. By the end of 2019 and into 2020, concerns in the market grew because of, coronavirus, things like that. What would have been the best allocation to be most effective? It actually would have been the blended futures allocation with the select bonus, right? Would anybody have been able to foresee that? Probably not. And again, 2023, 2022 saw inflation spike, right? Equity markets tumble, interest rates skyrocket. And on top of all this, Russia invaded the Ukraine, right? Political tensions raging all over the place. What would have been most effective? The S&P futures, actually, with the select bonus. But did we know that? No. Did you know that? Probably not. If we take a look backwards, and if we chose in every year from 2012 to 2023 the best possible option, if we had the crystal ball, it would have averaged 18.22%. Okay, great. We don't have the crystal ball. So we introduced diversification premixes. Okay, this is a great opportunity for you to take to your clients and say, hey, you know what? When it comes to your investment strategies, are you conservative? Are you moderate? Are you aggressive? Now you have a direction, right? And now you can say, okay, you're conservative. Great. Let's look at this. We're going to take 25% blend on the classic bonus tier, which comes with the 1% guaranteed flat rate bonus. It is contractually guaranteed for the life of the policy. They will never have a 0 year. Okay. If we take a look backwards and we say from 2012 to 2023, if they had just been in this conservative premix, they would have averaged 11.79%. Not too shabby, right? Again, we're illustrating at 6.72. If they were actually averaging 11.79, think of how much greater the projections would have been. Okay, maybe they're moderate. Now we're going to take this 25% blend on the bonus allocation tier, right? The 15% multiplier bonus. If we took a look backwards, the average crediting, 12.126%. Not bad at all, considering if they knew exactly where to go, it was 18%, 12, almost 12 and a half, not too bad. And if they're aggressive, we look at the select tier with the 40% bonus multiplier and the 1% asset charge. Now, again, we take a look backwards. Yeah, there's a couple of years where it's maybe negative 1% or so, but the average would have been 13.22% over the course of that 11-year span. Again, for those that really want to take a look at always having some kind of return, maybe a little bit even above 1%, we can have a fixed allocation bucket. Okay, so we've got the conservative, moderate, aggressive, but there's a component to it. There's a 20% component to it in our fixed allocation bucket, which is 5.4% currently. So again, marketing materials galore out there for you guys. This is an opportunity for you guys to look at this information, learn more about our product. Again, NFI is one of your greatest resources and allies. We are always here at Allianz to help you guys out. But there's tons of tools and resources for you as well in the producer portal if you want to go out there and explore yourself. But again, that's what I have so far for you guys. I can't, again, thank you so much for attending today. I know that I'm going to kick this back over to Emma because we're going to do a little bit of Q&A. And, again, thank you guys so much for attending.
Absolutely. Thank you, Mehul. That was some great information. Again, if you have any questions, now's the time to send them in the chat. Starting off with, I think you mentioned this earlier in your presentation, but could you go over the submission deadlines for the risk class upgrade?
Yes, absolutely. It's a great question. It's one we get quite a bit of these days because we did run this program for almost 2 years. So basically by Monday, so 9:30 at 2:59 p.m., this program will go away. But again, anybody that submits an application prior to 3 o'clock on Monday, okay, is going to have access to this risk class upgrade program. Even if they still got to go through underwriting or there's, EPHIs going on or receiving medical records, any of that stuff, as long as it's received before 3 o'clock Monday, you will have access to it and potentially our best risk classifications for your clients.
Perfect. Will the risk class upgrade program ever be back by chance?
That's a good question as well. That's another one we get quite a bit. It's always possible. This was originally used as a bridge from our previous product to the new product. And again, but I mean, there's always the possibility of promotions or, short-term scenarios. I don't think it'll ever run for 2 years again, but we may run it for a 3-month span, 6-month span down the road. The nice part is we do our own dynamic hedging in-house. And since we started doing that in 2006, it's saved us over $2 billion of commercial banking fees. So we like to pass that along to our clients, right? It's a great opportunity for us to give a little bit back to the clients who put their faith in us.
Absolutely. Would you by chance be able to explain the 4.5% lock on the PIMCO volatility index?
4.5% lock. I'm not quite sure I'm following the question, but the lockable opportunities. So index lock is a fluid situation. Okay. As the year progresses, the client's policy year progresses, if they are in any of our 4 lockable opportunities, again, it's the BUD-B3, the PIMCO, the S&P futures, and the blended futures. Those are all 4 uncapped, fully lockable strategies with participation rates. Okay. You can go into the producer portal. Your clients can go into the client portal, look at what their allocations are currently doing. It is fully transparent in there. It will show the starting value of that index, and it will show what it is as of market close yesterday. Okay. So it will also show them what they could potentially lock in at. So again, whether it's 4%, 6%, 8%, I'll be honest with you. As Emma said, I've been in this business for 8 years. I've been with Allianz for only a little over 2. I was in your shoes. I was in the personal production side of things. I also ran an AFMO. So I have clients that I still receive those index lock reports for. The last one I received for 2 of my clients, the lockable opportunity on the PIMCO is 21.22%, and the BUD-B is 16.3. So again, my advice to them is going to be, you know what? That's a blended value of about 18, 19%. I think we might want to take that because we have an election year here going on. We have no idea what the market volatility is going to do. I would say take the 18, 19% and run because that is an unbelievable opportunity. And again, the sky's the limit with locks. So, again, they have opportunities, limitless opportunities throughout the policy year. So again, locking an opportunity is very fluid, but it is available on a daily basis. It's available to set targets at any point in time. So those are the opportunities that you have. I don't know if that answered the question or not because I wasn't quite clear on it, but hopefully that gave you guys a little bit more insight into index lock.
Yeah, absolutely. Just one more question here. If there's no serious underwriting issues, what's the average time for submitting an application to be issued?
That's a great question. So our accelerated underwriting guidelines are going to be for clients ages 18 to 60 years old, okay, and policy values of $3 million or less. So face amounts of $3 million or less and ages 18 to 60. What we're going to do is we're going to take the application in, okay, that's usually a 1 to 2 day process when we get the application in-house to get it keyed into our system. And then what we're going to do is reach out to your clients to either complete an electronic personal history interview, or if they choose to do it over the phone, they can do that as well. So depending on how quickly they get that completed, let's say it's within a day or so of receiving the email link, they get that completed. We're in the meantime pulling all the other things that we can, the MIB reports, the DMV, all of those things we're gathering and getting in-house. Now everything is going to go to the underwriter. And if they see no red flags and everything looks good to them, they don't need any additional information, they will move straight through to an offer. So usually within probably I'd say a week or less, they're going to have an offer and could potentially be delivered and out the door. So it all depends on how quickly we're able to gather the information, how quickly they get on top of things like their PHI, stuff like that. We're going to, as soon as we gather everything we need, we're moving it straight through to an underwriter and they're going to take a look at it as quickly as possible.
Wonderful. Yeah, that's great. Unfortunately, it does look like we're out of time for today, folks, but thank you so much, Mehul, for sharing your insights today. We really do appreciate your time, and thank you to all of you for tuning in. Contracting with NFI Solutions and Allianz brings your clients financial success within reach. Should you have any questions or need any additional support, certainly contact NFI Solutions at 952 887 1239. We're here to help you every step of the way. So stay informed and keep striving for success. Thank you all for joining us, and we're excited to see you again at our next webinar. Take care.
Thank you, everybody. Have a great day.